a slight delay, but we will kick off right now. So this morning, my name is Zama Zulu, and this morning's webinar is focused on a form of ESG investing, specifically Shariah Investing. And we are joined by Imtiaz Suliman, who is a portfolio manager at Sentio Capital. And he specifically does manage the 2 Shariah funds that Sentio offers. In this presentation, he's going to take us through how Sentio's approach to Shariah investing is differentiated from other competitors that do offer similar capabilities, and how Sentio's approach to Shariah investing results in better risk-adjusted returns over time. If you have any questions, please make use of the Q&A tab at the bottom of your screen. And when Imtiaz is done with his presentation, we will then have a Q&A session and we will start reading out those questions. Thank you very much for your attention, and I'd like to hand over now to Imtiaz. Thank you, Imtiaz.
Thanks, Sama, and thank you all for joining us for this webinar today. I'm going to take you through our investment process, the Shariah offering that Sentio has, as well as our current investment outlook, and we'll end off with a short Q&A session. So if you do have any questions, either type them out or we'll give some time at the end for some Q&A. Thank you. Just in terms of Sentio and what Sentio is all about, if you want to summarize the Sentio philosophy, it's about sustainable practices, both from an investment perspective, but also from a business perspective. And I'll touch a bit more about ESG and how we incorporate that into our investment process in the coming slides. We think it's quite important to be humble and unique. In investments, you often do get things wrong. And when you do get a call wrong or an investment position wrong, it's important to acknowledge that, take corrective action, and not hold on to a losing position. We use a lot of technology and quants in our investment process, and that's what makes Sentio unique in terms of the way we integrate quants and technology with human experience, which I'll talk a bit about just now. Just on the next slide, our investment process is about AI and human integration. So what we all about is about combining human experience with AI and machine learning. And it's important that we have this integrated process. Often humans have biases which needs to be taken into account, and machines models break at certain points. They can't cater for changing environments. And we've seen that last year was a typical example of the huge drawdown that we saw in the market, precipitated by a health crisis. And this was something that wasn't seen in recent times. If you had to go back 100 years to the Spanish flu to have a similar event. So what Sentio is all about is the integration between AI, human experience, and importantly, it's not a black box. We think it's quite crucial to bring the 2 elements together to make sure that you bring out the best of both investing worlds. So how do we integrate this human experience with AI and machine learning? It's all about knowing what's going around us. How do we make sense of the noise of the macro risk that's out there, and distilling a lot of the data into inputs that allows us to target our thinking to make sure that we increase the probability of outperforming regardless of the market styles. Often you'll see trends persist in the market. We know that growth has been a very strong driver of market performance over the last 10 years, trumping value to a large extent. What we're trying to do is outperform regardless of the market style. And that's why our investment style is one of being style agnostic. And ultimately, you want to find the stock or bond or commodity, whatever asset class or instrument that is, to achieve that investment goal. And that's about, using human experience and skills to pick the probability or the highest probability of outperforming a certain benchmark. We then bring this together in a scientific way to build a robust portfolio that is cognizant of risk, but also taking active risk. There's no reward without risk. And also you need to make sure that any position in the portfolio is an active position and know exactly what risks are in the portfolio. So if just to summarize, the two blocks in blue is what is artificial intelligence and machine learning that's assisted by the human experience with the block in red. And that's all brought together by the portfolio construction and risk techniques that we employ in the fund. To summarize the Sentio process, it starts off with the bottom-up fundamental analysis. And basically, if you want to summarize it, it's 3 questions that we ask. What are we saying about the company? What is company management saying? And what is the market saying? If any of these answers to these questions differ, that presents an opportunity or an arbitrage opportunity to take advantage of those differences. Machine learning is brought into account to cater for the themes or the regimes that we think are rewarded in the market. For example, you might have a risk-on mode in the market whereby high-risk stocks will outperform defensive-type stocks. And if you're finding a lot of bottom-up value in the defensive stocks, you might want to temper that back in the portfolio because your machine learning and regime analysis is pointing you towards an environment that is very supportive for risk assets. We then take into account the macro analysis, and this is to bring in the macro trends that are prevalent in the market at any specific point in time. We've seen that fiscal and monetary policy issues have become quite topical, and that's been a big driver of markets of late. So it's important to understand the macro environment that we operate in and which stocks are going to be more affected by a particular macro environment. This is all underpinned, again, by a very strong risk management process to make sure that we have diversification across different asset classes, different factors, and different sectors within the market. And this is important to make sure that we have, again, conscious risk in the portfolio, but also active risk and knowing what those risks are so that we don't take any unintended bets in the portfolio. The Shariah Index is a very highly concentrated index. If you look at the makeup of that index, 66% of the index is made up of resource shares in particular, and it's very concentrated in terms of the number of stocks that make up the vast majority of the index. So if you look at the top 5 positions in the Shariah Index, that makes up over 50% of the index. To summarize the characteristics of the Shariah Index, it has a very high concentration, very high volatility, and low diversification. What we try and do in the Sentio Shariah Equity and Balance Fund is lower that concentration, lower the volatility, and increase the diversification. How do we achieve that? We achieve it by 2 main components. The one is bringing in an element of global into the portfolio, and global provides a diversification element into the fund that is not achieved by investing locally. So, again, the local index very high concentration towards the resource sector. By bringing in the global element, you bring in the growth and quality factors that's lacking in the South African market. Secondly, when we do optimize the portfolio, we optimize towards the capped SWIX index, which is a much more diversified index and gives you a factor exposure that is well diversified across different asset classes and factors. So to summarize the Sentio Shariah Equity Fund, you can see that the concentration is at 3.9, the volatility is at 10.5%, and the PDI, which is the Portfolio Diversification Index, is at 10.9. And again, this is better than the JSE CapSwix Index, and and much better than the Shariah Index, which has a PDI of 2.7. Essentially, what that means is that there's just 2.7 bets that one can take in the portfolio by investing in the Shariah Index. The chart in front of you shows a representation and actual outcome of the fund in red relative to the JSE Shariah Index. And what I want to highlight here is that you can see from the SAE equity volatility, the Shariah Index has a very high beta because of the high concentration towards resource shares. We've managed to bring that down to 0.76. And if you look at some of the other factors, they tempered as well in terms of their exposure. So our fund has given you a very stable return profile. And what we're trying to avoid is the huge drawdowns that you do get when resources tend to go down. But also, when the market does recover, we want to capture that upside. And by having a more diversified portfolio, a well-balanced portfolio, and taking that active risk enables us to achieve that outcome. So just to summarize the Shariah portfolio construction methodology, the high concentration of the JSE Shariah Index creates a very low diversified fund. We use the portfolio construction techniques to construct a portfolio that is more diversified and mitigate some of the risk. And we bring in machine learning to target our thinking in those areas that present the best opportunity. And then again, diversification is very important to achieve those outcomes in a very stable manner. And this ultimately leads to better risk-adjusted returns that is unique, that we think, to our fund relative to some of the other Shariah funds that's in the market. I'm going to take you through a case study of how we go about selecting stocks for the funds that we manage, and also how we bring in the AI and machine learning element in the whole process. So the stock I'm going to talk about is Clicks. And what you can see there is this triangle summarizes the investment process that goes into any equity stock call that we make into the portfolio. It starts off at the bottom with AI regime analysis. We bring in the ESG elements, and importantly, there's a lot of talk around ESG and the way investors are viewing ESG. Our thinking is that it's important to make sure that ESG is done by the analysts themselves, and also that it encompasses the broader aspects of ESG rather than environmental, social, and governance issues. You need to follow the timeline, look at what company management are saying. Are they doing what they're saying? Is the culture of the company suited for better ESG outcomes relative to another company? And we then bring in the big data, macro data, as I mentioned, to target our thinking. What you ultimately want to do is find what are the drivers of the company. Different companies will have different drivers. For example, for our resources, we know it's very dependent on commodity prices, but what's the driver of valuation is the change in the EBITDA from year one to year two. For a company like Clicks, an important driver is its return on equity and return on assets. It's a very high quality company that produces strong cash flows, and any change in that cash flows affects its valuation more so than a company such as an Anglo American, for example. Looking at the drivers of revenue, you want to decompose those drivers into its elements, whether it's space, volume, inflation, and then going down the financial statements, looking at the gross margin, operating margin, the business strategy. And ultimately, it's important to understand which valuation methodology to use for a particular company. Each company will be driven by different factors, whether it's a company that returns a lot of cash to the shareholders, a dividend discount model or DCF valuation will be more appropriate in that sense. Whether it's a high growth company, a DuPont analysis will be more suited towards that. So it's important to understand what the company is about and which valuation method works best. Supporting the whole investment thesis is scenario analysis. And this is important because a point forecast will be wrong more so than right. We think that it's important to understand what are the ranges of the valuation outcomes, because you'll never get the exact target price for a particular company. And this all leads to a probability adjusted valuation that we use for any company that we analyze. If you look at the scenario analysis and the drivers of that, there's certain drivers that will affect companies differently. For a consumer company like Clicks, understanding what's happening to real wage growth in the economy, how is gross fixed investment evolving, because that impacts employment and that impacts consumer confidence. From a sales growth perspective, here we bring in the AI and the machine learning side of the investment process. You want to get real-time data. Often when data does come out from a macro perspective, whether it's GDP or unemployment figures, these are lagging and they becoming more and more irrelevant. The market has been pricing in data more in a timeless fashion, and this is important to bring into our valuation methodology, because waiting for those unemployment figures, waiting for GDP data is too late. The market is dynamic, the market is evolving, and information and data is getting incorporated into valuation much more quicker than in the past. So, we think it's important that AI and machine learning is another tool that we have in our valuation methodology. And it's quite important to make sure that you incorporate this, because if you don't, you're just going to be behind the curve. And we want to analyze a company from a bull, bear, and base case scenario, because the macro environment is constantly changing. You want to understand what's the valuation ranges for a particular company and whether there's support if we have a downturn in the economy, if the economy performs better than one expects. So that valuation range is important to understand the different valuation outcomes of a particular company. If we go into the three questions that I spoke about, and particularly for Clicks, what is the market saying? What is management saying? And what are we saying? The market is well aware of the fact that Clicks is a very well-run company. It has a low capital allocation risk, and it's a consistent performer. It does warrant a premium valuation given its steady earnings and its strong cash flow. What is management saying? Management is very clear on their strategy. It's all about bringing the pharmacies closer to where their customers live, but also bringing in that convenience aspect of the basic healthcare products, which then drives the cross-sell into the front shop, and that gives them that virtuous cycle of consumers coming into the stores, getting their prescriptions filled, and also buying something from the front shop, which drives that cross-sell between the customers. The other strategy is growing the wholesale part of the business, which is UPD, and they've built a very strong footprint in terms of DCs and logistics to cater for their growth. What are we saying? We do agree that Clicks is a very well-run company, very high returning business. The marginal buyer of Clicks has been the offshore investor. And it's important to understand what are the offshore buyers thinking for a particular company, because a lot of the shareholding of our consumer companies listed in our market is held by foreigners. If you don't understand how foreigners view a company, what is their thinking, often you'll miss out on a company's strong run, because the foreigners will get in first, and then locals will come to the realization that the company is either a good company, well run, good growth, etc. Pharmacies are an important element of the strategy for Clicks, and we think there's an opportunity for them to partner with government to roll out the vaccine, given their strong footprint as well as their strong capabilities to administer the vaccine, and that will provide an additional benefit in terms of footfall into their stores. Again, the independent market share is at 45%. We've seen this market shrink over a number of years as the corporate rollout has gained foothold. So the likes of a Clicks and a Dis-Chem really taking market share from the independents. UPD is the wholesale division that I spoke about, and they've built a very good capability to distribute product either to their own Clicks pharmacies, but also to the big hospital groups and the independent pharmacies. And what this provides Clicks with is intel into which areas are growing quite significantly from a prescription basis, and that informs them of where to roll out their stores. So it's a very valuable element in the Clicks table. It has good margins. They've got good facilities in terms of the location of the DCs, but also the technical expertise to deliver some of the highly complex medical equipment and supplies, whether it's requires refrigeration, whether it's time sensitive, and also making sure that those products reach the end consumer in a very efficient, timeless manner. If you look at the return profile of Clicks, it's a high returning business, as I mentioned. The return on assets are well above its peers. The return on equity also well above its peers. And this allows Clicks to use its capital in a very efficient manner. They've been buying back shares at a consistent manner over a number of years. They've also paid back dividends as well as special dividends because of the high cash that they do generate. And their CapEx rollout has been well funded from internal resources. We do like companies that generate high returns of cash, that don't have to go out to the market to either raise capital or to make acquisitions to increase their growth profile. And Clicks gives you these two elements of a high growth company, high returning company from internal resources. And that's an important element for the valuation and valuation driver of clicks. If you look at the big data, the chart on your left summarizes the timeline of the lockdown that the country experienced in March last year and the evolution of that. So if you just focus on the green line there, you can see there was a huge uptick in residential activity, rightly so, as the country went into lockdowns. But if you look at the orange line, which is the grocery and pharmacy activity, as we went into the hard lockdowns, it fell quite significantly, but then started to recover also very quickly and surpass pre-COVID levels. And this is important because if we didn't have this data and didn't incorporate this data into our analysis, we would have been behind the curve in terms of forecasting what Click's potential earnings could be, but also the rebound in economic activity that we see in the economy. And when companies have been reporting, especially the domestic stocks, we've seen them report better results driven by a rebound in the consumer. And if you just rely on the news reports coming out, things would have been quite bleak. We know that there were job losses that were suffered in the economy, but we also do know from the big data and from company results that the economy performed quite steadily, did rebound. There were certain sectors that did take strain, but other sectors fared incredibly well. The chart on your right really reflects the promotional activity in the market. So if you look at clicks, which is the second bar on the left, the promotional activity was less than 2019 levels. And what this tells us is that the margins are going to be better than last year because they had less promotional activity, but also that they didn't need to promote as much because of the stability that we saw in the consumer and also the higher economic activity levels. We took this into account into our valuation and stress tested our models, which allowed us to be at the forefront rather than incorporating this data when the company reported their trading update. From a peer group analysis, it's always important to understand how does Clicks fare relative to its peer group, but also from an international perspective. And if you look at Clicks, it has a very high return on invested capital of 13% and trading on an EV/EBITDA multiple of 15 times. Now, this might look expensive in an absolute sense, but if you do incorporate the return metrics of Clicks that I spoke about, the cash flow generation, the high return on equity, that premium valuation is justified. Some of its international peers, such as a Drogasol, which you see there at trading at a 25 times EV/EBITDA multiple, is also a high returning business, very highly rated by foreigners as well, but also trading at a much higher valuation than Clicks. A Dis-Chem, for example, is one that we also analyze in the same sense, but Dis-Chem has a very unstable earnings profile. They're still transforming from a family-run business to a corporate environment. And for that reason, we use a DuPont valuation for Dis-Chem, whereby for Clicks, we value it on a DCF basis because we're very certain on the cash flow generation of Clicks and also the certainty of that cash being returned to shareholders. Whereas Dis-Chem is still in a build-out phase, making acquisitions. The latest acquisition was the acquisition of Baby City, as well as the wholesale division prior to that. So they're still in the build out phase, and we think cash flow is not going to be consistent as you might get from a clicks. From a scenario analysis, the base case is that there will be this COVID vaccine rollout. Promotions are part of Click strategy. It's going to be there, but less pronounced as in 2019. And UPD is going to continue to gain market share from a wholesale perspective, given their strong positioning. And on that basis, we have 18% upside. To summarize the bear case, if the economy does pan out to be worse than our expectations, UPD doesn't have as strong of a rollout in terms of new clients. You get 4% upside. And if you look at the bull case, if things are going better than expected, the economy is growing much more strongly, and UPD is gaining market share over and above their normal growth rate, you could have an upside of 31%. So what this summarizes for us is that even in a bear case scenario, you do get some upside in clicks, but if things go really well, you're looking at a potential return of 31%. I'm going to summarize our positioning and performance in the next few slides. Talk a bit about our top holdings and our targeted asset allocation. If you look at the Sentio Shariah Balance Fund, our targeted return there is CPI plus 5 to 6%. Its benchmark is the CISA multi-asset high category. And we're targeting a volatility of 8 to 12% per annum. What you'll see in the numbers just now is that volatility has consistently come in at the lower band of that 8 to 12%. From an asset allocation perspective, the prudential limits allow us to have an asset allocation in terms of equity from 0 to 75. We would typically be around a 50% mark if we think we're in a normal equity environment. And currently you see that we have an overweight equity allocation if you add the local equity with global equity, we're sitting at 63%. From a sukuk perspective, we're allowed to have 5 to 50%. We have local sukuks of 15% and global sukuks of 10%, which brings the total to 25% there. Just on the top 10 positions, I just want to highlight two things here. What you can see is that we've got a strong or higher weighting towards domestic SA Inc. stocks, so the likes of a Mr. Price, Bidvest, Clicks that I spoke to coming through there, but also some of the resource names coming through in terms of a BHP Billiton, Sibanye, Anglo American. And importantly, these weightings are much more diversified across the number of stocks, but also in terms of the absolute weighting. And this is crucial to make sure that the volatility of the fund is well controlled, but also for any downside protection, given that Sharia funds cannot invest in derivatives as it stands, although there is some advancements being made on that front. But our protection is really diversification and also portfolio construction to manage the risk in these portfolios. From a performance perspective, we've had a very strong 3, 6 months and 1 year. And that's largely been through stock picking from some of the domestic names which have performed strongly, but also the resource sector benefiting from higher commodity prices, a tight supply environment that we see coming out of China and its demand for commodities. And to highlight here that volatility has been 8%, which is at that lower end of the 8 to 12% target. If you look at the equity fund, That's also performed strongly over the last 3 months. The 1 year has performed slightly less than the median of the ASISA category. And that's due to the fact that resources have performed strongly, but also NASPERS, which has been a very strong performer, is not Sharia compliant. And we haven't had NASPERS in the fund, although we did have some of the other tech names on a global basis to cater for the lack of tech exposure that one sort of loses out by not having NASPERS in the fund. I'm going to summarize the investment outlook and our thinking from a global and local perspective. Basically, the globe has been awash with liquidity. Central banks have been on the front foot in terms of making sure the economy is stable and functioning, but also not allow bankruptcies to spiral out of control. And what's been very different this time than some of the other crises that we've seen is that fiscal stimulus has been very important in making sure that the man on the street rather than Wall Street benefits, although the vast majority of the liquidity that we've seen has been towards Wall Street. We think with the Biden administration, that will change somewhat. We should see higher taxes coming through for corporate America. And we think that the liquidity environment is going to be very supportive for equities going forward, and any market sell-offs are an opportunity to increase equity exposure rather than to panic, given the strong rebound that we see in terms of the earnings front, which will support the valuation levels of the overall market. From a local perspective, South Africa does have its challenges. We know that we face a looming fiscal cliff if we don't get our house in order. We need to rein in expenditure. We need to bring down debt. And, you know, the recent budget speech by the minister was quite sobering in terms of what the risks are, but also what we as a country can do. So it was quite welcoming that the revenue overrun of close to 100 billion rand was supported by a favorable commodity environment, higher tax receipts coming out of corporate South Africa. And that informed our positioning of value over growth, and over value and growth over quality and low risk. Importantly, we style agnostic, but we see a valuation opportunity opening up between value and some of the growth counters that you see in the market. Importantly, for us to see a sustained re-rating in the market, we need to see strong reform coming through. We need to see more public-private partnerships being rolled out, and an environment that is more conducive towards business. South Africa suffers not from a lack of policy, but rather from policy implementation. And it's important to see an acceleration on that front for a sustained re-rating in our local market. To summarize, from a macro perspective, we've got monetary and fiscal policy that's very supportive. Global growth is recovering off a very weak base. You could see global growth rebound quite strongly this year. You know, estimates of the US are for 5 to 6% GDP growth, South Africa between 3 and 4%. Geopolitical risks are high, but are receding under a Biden administration. However, we think the long-term geopolitical tension between China and the US will persist, given that it's a bipartisan issue. And as China grows in its economic stature, that's putting pressure between the two superpowers. From a market perspective, we expect equity to still be the place to be, value to outperform growth, and the search for yield to continue as we see bond yields trade at historic lows, although we've seen some sell-off recently. We think that it's too early to panic, and some of the sell-off is warranted given the stronger economic activity that we've seen. From a volatility perspective, volatility will remain high. Markets will be dictated by liquidity, but also by an increased participation of retail investors that we've seen over the last year come through. And it's important to make sure the risk management aspect is well catered for, and any tail risk in the market is well balanced, either by having a diversified portfolio and having some of the hedges such as gold, which makes up the diversification part of the portfolio. The fund is offered on a number of platforms. So if you look at the Sentio Shariah Balanced and Equity Fund, they both offered on the Discovery, Glacier, and Momentum platform, and the Balanced Fund on the Stanlib platform as well. I would leave it there and take questions, and thank you for joining us for this webinar today.
Thank you, Imtiaz. I'll read out the first question on the Q&A tab. Thank you, Shahi Peters, for your question. It says, are there any arbitrage opportunities identified in the currency markets?
In terms of currencies, we don't forecast currencies. The way we bring in the currency element is to see what's priced into the various equity instruments that we invest. So for example, if you have a Fushini, for example, they've got operations in the UK, they've got operations in Australia. What we try and understand is on the current spot prices, what's reflected in the share price at the moment, and if currencies do value, how would that affect the valuation? So this is brought in from a bottom-up analysis in terms of the equities that we do invest. If you look at our global element of the portfolio, we invest in companies that are growing quite strongly, have a stable cash flow profile, and also bring in the quality factor. Currencies are important in that aspect, but the only currency that we do bring in our investment philosophy is what is the rand dollar potentially going to be, and what is the forecast and outlook for the rand dollar. And that's brought in by our macro team, and their forecast takes into account the local risk factors, the macro risk factors, as well as PPP valuation for the rand dollar.
Thanks, Imtiaz. And then the other question, so you've mentioned that Sentio's differentiated process is one way you amalgamate the artificial intelligence and machine learning together with your fundamental research. What happens in a situation where your AI and machine learning analysis is contradicting what the fundamental analysis is showing? How do you then make your final investment decision?
Yeah, thanks, Zama. I think that's a very relevant and valid question. It's never going to be one over the other. If there is a difference between the AI and machine learning, that presents an opportunity for us to revisit the process and what we call the champion-challenger engagement. If we have a situation like that at the moment coming through from gold. So our bottom-up returns are showing very high returns for some of the gold counters, whereby the AI and machine learning element is saying that gold is going to lag, given that we're in a risk-on environment, the world is getting better, GDP is going to be stronger, and gold, which is seen typically as a hedge in the portfolio, will underperform. What we've done in that scenario is make sure that we're not overly exposed towards gold because our machine learning is saying that there are better opportunities out there, but we haven't neglected the fundamental bottom-up analysis in the portfolio. So we've got Harmony in the portfolio, which is the highest returning counter, we think, and Goldfields is the lowest returning counter. So it's a balance between the two. And I think it's important to highlight that it provides this champion challenger questioning process. And at some points, the AI and machine learning will take precedence. And at some points, the human experience and knowledge will take precedence. It just depends on which environment we're in and what is the different factors and different scenarios showing. So it's a holistic approach, and there's no one answer whereby AI or human experience will dominate at any one point in time. At any point in time, it's always an integration of the two.
Right, thanks very much, Imtiaz. Ladies and gentlemen, that now concludes this episode of the Thinking with Sentio webinar sessions for today. I hope you all enjoyed that and you found it worthwhile. If you have any comments, please feel free to contact Sentio if you have any further questions. Thank you so much for your attendance and for your attention. And I hope that you will enjoy the rest of your day. And we look forward to seeing you again at the next episode. Thank you. Keep well. Bye.
Thank you.